Hello, everyone. Welcome to today's accounting design project. Today we have Haifeng from Tsinghua University to discuss AI adoption, mutual fund short-termism, and real investment. Haifeng, the floor is yours. Yeah.
Okay, thank you, Ayun, and thank you for accepting our paper to the series. As I said, it's a great service to our profession. I'm really glad that I have opportunity to share our research with the audience here. So this is a project I did with my PhD student at Tsinghua University. So he's actually a current first year PhD student. So he did a lot of the hard work for this project, and he's in the meeting as well. Okay, so the paper is about AI adoption, how that affects the information acquisition horizon of investors and the capital market consequences. So the part of the motivation, as I just discussed with Ayun, so I used to work as at an asset management company, and I still kind of collaborate with some of hedge fund. So one thing I observed that they're all quite excited about machine learning AI technology, and they very kind of aggressive adopt technology. But once they adopted it, what I observed casually was that they tend to treat faster. So they tend, even some of them maybe even move towards kind of high frequency, but a lot of them even not move to high frequency, but they kind of feed faster. So, and then I was thinking about what is the implication and why is that? So that's kind of one of the reason that motivation lead to this study. So I don't have to say too much about AI adoption. Everyone know that it's essentially everyone is adopting AI right now, and especially uh, uh, financial industry investment company was one of the early adopters. So now I guess so the number here probably understate the prevalence of AI adoption already, but it's showing that most of a lot of the investment company uh, kind of adopt the AI even kind of well before this ChatGPT or Gen AI period. Um, so uh, 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 so our focus is that whether this AI adoption may affect investors' information acquisition. So that the motivation that lead to our research is kind of my casual observation, but I was thinking why. So one thing I also observed from kind of my own experience of apply AI or machine learning investment is that I find AI was particularly useful or powerful in kind of detect or uncover short-term patterns. But if I use AI to make a long-term forecasting, in particular, if it's try to make long-term causal reasoning or qualitative analysis, it is not really that powerful, especially before the Gen AI period. So it's a research by Dao and Sidok basically kind of conclude. So this is a working paper written into 2025. So they say, so far AI method have not been feasible for long-term investing due to the difficulty of creating a suitable knowledge base for investing. So that's one side is the effectiveness of AI in discover long-term or short-term information. So the other side is about the incentive about but suppose you can use AI to kind of discover both short-term and long-term information, then how much you can really monetize that information, and how easily to monetize information. That also varies with the information horizon. So if it is long-term information, if you want to monetize, it has to involve a lot of uncertainty and greater risk because the actual outcome will not be realized maybe a long time into the future. And a lot of unexpected kind of shocks can happen. So that increase the risk of those investments. So that also decrease the incentive to collect or acquire long-term information, even if AI may also be useful to a certain extent for long-term information acquisition, right? So that lead to several kind of research questions or predictions. So we basically try to answer 3 research questions in this paper, related research questions. One is, does AI adoption make investor, in particular here, we focus on mutual fund. They're more short-term oriented in their information acquisition. The second is kind of capital market consequences. So if adoption make mutual fund more short-term oriented in information acquisition, if there's less information, long-term information will be acquired and discovered. So maybe less long-term information will also be reflecting stock prices. So that will affect the stock price effectiveness across different time horizons. That's our second research question. And our final research question essentially about the role of stock price in guiding firms' investment decision making. So we know that manager rely on stock price sometimes, right, to learn, or there's managerial learning. They try to learn some information from stock price to help them to make investment decision. But if stock price become more short-term oriented, this may become less useful to make a long-term strategic investment decision, right? So if manager realize this, they will rely less on stock prices for their investment decision making. So that's kind of a 3 research question or kind of predictions we try to investigate in the paper. So a quick preview of the main result is that we first find that AI adoption exacerbates short-term information acquisition. So the short-term means here does not really mean that it's irrational. It's actually it's perfectly legitimate, perfectly rational decision for the mutual fund managers. But what we find is that after AI adoption, we find a stronger association of mutual funds trade or transactions with short-term future earning news, like 1 to 4 quarters ahead. But the association between their trades and future long-term information, so there's a typo here, longer-term earning information, 9 to 12 quarters ahead. So basically 3 years ahead. So that's actually the association become even less. So with respect to the stock price effectiveness, we also find there's a change or shift in the stock price effectiveness pricing. So stock price are more informative about short-term future earning or fundamentals, but less informative about long-term future fundamentals. And finally, there's a kind of real effect. We find there's an investment Q sensitivity decreases when the investors for stock with high AI investor ownership. So basically, there seems to suggest firms rely less on stock prices for their investment decision making. So that's kind of the main result we find. So now I'll just go to the hypothesis. The first hypothesis I mentioned just now, we try to understand whether AI adoption exacerbates short-term information acquisition. So the reason, the idea behind this hypothesis, there are several reasons, right? One is that, as I mentioned, the current AI system. So when we start to write this paper, or most of the sample also predates the ChatGPT, that the prevalence or popularity of ChatGPT. So most are focused perhaps on the classic machine learning kind of era. So the current AI system are highly effective at extract kind of insights kind of from high frequency, high dimensional, even alternative data sources. But kind of long-term forecasting rely on causal inferences, scenario analysis, qualitative judgment, etc. That's still quite challenging for a current AI system. especially for classic machine learning. But even for currently Gen AI period, for long-term, really long-term kind of scenario analysis or causal inference, etc., I think it's still challenging. There's a lot of limitation with our current AI, the Gen AI system, like large language model. There's a lot of hallucination issues, the other biases literature find. I think those biases are particularly will also more pronounced for longer term as well. But most of our paper or the sample focus on the pre-Gen AI period. So, and the third point is, as I mentioned, so even if AI improves the long-term forecasting equally well as with short-term forecasting, but monetizing long-term information involve more risk and uncertainty, so which kind of decrease firms' incentive to do so, right? Because that's essentially reduce the marginal benefit of such information acquisition, right? So the first 2 points is that you can think about from the cost perspective, right? AI or machine learning basically lower the marginal cost of short-term information acquisition more than kind of the long-term information acquisition. The third point is about the marginal benefit. I think for both reasons, so we may see the marginal benefit or the net benefit of long-term information acquisition may actually be not as higher, may not be improved as much for short compared to short-term information acquisition. But information processing attention and also resources are limited, are scarce. So it must be optimal allocated according to the literature, right? Or just based on economic reasoning, right? So if we see a substantial kind of increase in the marginal benefit, net benefit of short-term acquisition brought by AI adoption compared to long-term information acquisition, we may see mutual fund may shift their attention or focus more towards short-term information discovery. So that's kind of the idea behind our first hypothesis. So if there's any question anytime, feel free to let me know. Okay. So our second hypothesis basically kind of built on the first one. So if there is more information, if there is a shift of focus towards the short-term information acquisition after AI adoption, so we may see it's also affect the capital market price, right? So because when mutual fund acquire information and trade on it, so this information will be incorporated in stock prices. If there's more short-term information are discovered or acquired, but less long-term information are processed or discovered, then we may see less of long-term information and more of short-term future fundamental information will be incorporated into the stock price, right? So that's lead to our second prediction is that high AI ownership may lead to an increased stock price informativeness about short-term future fundamental, but may decrease the informativeness about long-term earnings. So the effect is not kind of homogeneous across different horizons. I think most of the existing research may focus, say, because AI help to discover more information, reduce the cost of acquisition. It may increase the price informativeness. It may increase the market efficiency, etc. But our second hypothesis suggests that this may be more nuanced, and it may vary across horizons. So you have a question, right?
Yeah, is it a good time?
Yeah, sure. Anytime.
Yeah, so it sounds like I think I have a question, kind of more kind of like a bigger picture takeaway from the study. So in the chat box, I shared an article published in Econometrica. So Stephen J. Terry presented early on this series, probably around 2021. And then his dissertation published in Econometrica was structural estimation, try to figure out in the US corporations, how does short-termism leads to the reduction in long-term R&D investments. And the reason he went with the structural estimation is because, for example, AI or any other technologies or catalyst, we observe on the capital market structures or executive compensation somehow would correlate it with the acceleration in short-termism, but like somehow we don't really know the counterfactual. Like in a world without AI technology available to firms, can we say in that world, somehow they were more focused on the long term, or somehow all those are kind of like correlated catalysts that without AI, somehow manager will find other means to still focus on short-term opportunities or investment because somehow their incentives in their compensation or other non-monetary engagement will actually motivate them to do so. So I think this is a little bit related on the causal inference, but a little bit bigger in terms of how do we interpret your hypothesis. Yeah.
I see your point. If I understand correctly, you're basically saying that maybe even if we observe some change, like time series change in, let's say, mutual fund short-termism, so it may not be really driven by, the increasing popularity of AI. It could be driven by some other contemporaneous driving forces, right? So that's certainly a perfect, legitimate concern. It's definitely true. First, I don't think AI is the only reason that will lead to short-termism, right? There's certainly other forces, and the other forces could be happening around the same time or similar time. So that certainly kind of pose some challenge to us for in terms of identification. So that's one of the biggest challenge. So we try our best to try to really kind of address that concern by using instrumental variable approach and also try to use some exogenous shock. And also another thing is that here we look at cross section. We're not saying like everybody will be affected to the same extent, right? So if there's a general time series trend, maybe it should be applied to every firm. So what we see here, for example, we also see this the high AI ownership firm. They're gonna this effect impact is more pronounced than low AI ownership firm, right? So that itself is kind of a contrast group that help to alleviate your concern, but I know it's definitely it's a big challenge to the paper, right? How do we kind of handle the identification issues, right? So do I understand your question correctly?
Yeah, I think I look at the tables. I would be curious to know like the determinants of using more AI versus less, right? That treatment control is not a random assignment, but it's more about the fund's choice. And that presumably will be driven by some of the omitted correlated variables that you mentioned earlier related to their
Yeah.
organizations.
Yeah, we have some results kind of along the line. We don't have a full-fledged kind of determinant analysis, but once we get to our IV instrumental variable approach, so you may see some of it and see whether that's kind of a help to alleviate the concern.
Thank you.
Okay. Yeah, thank you. So and then our third hypothesis on the basically on the decision usefulness of stock prices. So this is again also related to very large literature on managerial learning, right? In using stock price as a signal to guide investment decision, right? So the all this literature about managerial learning, right? So it's basically it's focused more rely on the idea that this optimal investment decision, right? That should be based on the present value of a long-term cash flow. And if a stock price forward-looking, right, then it can provide some information, right? Can provide some feedback value, signal value, and so to help a manager really make better investment decision. But so that's in order for stock price to be really useful, stock price should really kind of be reflective of long-term fundamentals. But if stock price due to the short term is if it is more like or if it's become primarily dominate the price fluctuation kind of become more dominated by short-term information or even short-term noises or investor sentiment, etc., then this price will become less useful, right, to guide for long-term investment decision making. So that's very intuitive, right? So that's what our third hypothesis try to test. So basically, want to understand, whether high AI ownership will lead to a decrease in investment Q sensitivity, right? So if manager also understand, when they have high AI ownership, this AI investors that treat more on short information, that makes stock price fluctuation more reflective of short-term dynamics rather than long-term value. So they should rely less as well, right? So that's basically the idea behind our third hypothesis. So all the three hypotheses are kind of related, but it's all kind of try to understand, whether it's the AI adoption will lead to a shift in terms of horizon of investors' information acquisition and the capital market and the real consequence of that, right? So that's our paper is about. For the sample, it's actually quite standard. So we look at active equity funds, right? Because passive fund, they don't really need to do much of information acquisition. We look at active equity fund and stock, public companies, like we got it from Chris Compuset, that's quite standard. So any questions?
Yeah.
Hey, Joshua, you have a question?
Yes, I don't have access to the proper hand. I'm doing it on my browser.
Yeah, no problem. Yeah.
Yeah. Does it matter which mutual funds you're looking at? So, for example, if the fund is value oriented versus growth oriented, I think that would translate immediately into whether they would prefer short term or long term.
Yeah, so short answer to you is that so for this paper we didn't really separate the investments, the styles or the focus of investors, but I can see that it's food matters. So because maybe value and growth fund they themselves differ in their kind of preferred horizon, right?
Yes, that's exactly.
Yeah. So I guess so they certainly have their own preference in terms of the horizon, but then the thing is, so with the shock, suppose we have a new technology. If our assumption is that AI or classic machine learning, they are more useful, they help to reduce the marginal cost of information acquisition more for short term than longer term. So on the margin, may even regardless whether you are a value investor or growth investor, once you face similar shock, I mean, it may still lead to such a change, marginal change on the effectiveness or the focus of information acquisition, even though you have some kind of a predetermined preference. Because to me, whether you're a growth investor or value investor, so you still need to look at, even for growth, you probably don't just want to look at growth in 1 year, right? You probably want to look at growth in longer term as well in short term. For value investor, if you think about valuation, you also need to kind of forecast the fundamentals quite long into the future and discount back to determine the value. So in either case, you need to forecast short term and long term. Now, if you have a shock that decreases your short term information acquisition cost, more than long-term acquisition, then our prediction may still flow through, but maybe given their ex-ante kind of focus, it will affect them kind of slightly differently, but the direction may be similar.
But there would be endogeneity in the. So if you are a growth manager, you may invest more in AI that gives you a short-term edge. If you're a long-term investor, maybe not.
That's true. That's true. So the AI adoption decision certainly is endogenous, right?
Yeah.
So that I see your point. Yeah. So we try to do something, try to alleviate, right? So one thing is that we try to match the sample control and treatment sample based on their shear turnover ratios, essentially like the horizons of their transaction, which I'm going to talk about later. And the other thing we look at exogenous shock. So for both way, hopefully that can alleviate that concern, that this endogenous concern. Yeah. Okay.
Thank you.
Yeah, thank you.
So Haifeng,
go
can I
ahead.
have a follow-up? I think Joshua's question is kind of like one example of my earlier question is the paper right now attempt to draw the causal inference from AI adoption to capital market investments and also corporate real investment. But I think potentially it's because the shareholders of those mutual funds have wanted more short-term results.
Sorry,
Yeah,
I
so
missed your last sentence.
those mutual funds. So like I think to kind of elaborate more on his question is overall, growth funds actually more popular than value funds until recently. So there are more and more investors actually looking for short-term returns. So that's why there are more and more growth funds over time. And AI is just one of the means for fund managers to meet the ultimate principal investors' preference. So the source of the short-termism actually coming from the investors of those mutual funds, but not simply just by the means, for example, AI adoption leading to the short-term outcome. Right.
I see your point. Essentially, it could be like you have some kind of short-term preference, which drive the AI adoption as well as the kind of outcome, right? That's again it's a good question. It's a great question. That's also the question we had in our mind when we did this analysis before. So it's hard to completely rule out the possibility, but we tried several ways. I can maybe directly jump there. So one thing is that we kind of do this match sample analysis. So we basically where is it? So here. So we try to match on the size, turnover, age, and holding, especially turnover. So we try to match the turnover before the adoption. The sheer turnover essentially kind of if you take an inverse of turnover, that's essentially the average holding period, right? It's average horizon, right? So if you essentially control the turnover or control their horizon before the AI adoption, and then you look at how this AI adoption affected, that's kind of partially should alleviate the concern, but it doesn't completely kind of rule out. So the other thing is that then we look at some exogenous shock on the effectiveness of AI. So which is like we look at we can't find a really kind of perfect exogenous shock, but we basically use two. One is the transformer introduction of transformer kind of algorithm or architecture. So that really kind of make AI technology more powerful in terms of forecasting or prediction or generation. And the other one is we look at the staggering introduction of satellite image or alternative data. So because AI basically shine with when you have more data. When you have a lot of small alternative data, the effectiveness of AI also increases. And then neither are correlated with the incentive or preference of mutual fund owners or shareholders, right? So it's more exogenous. And then we showed that after this exogenous shock, then the short term is become more exacerbated or more pronounced. So that's kind of what we try to use this instrumental variable, also try to measure sample. We also use the instrumental variable, which is also kind of unrelated to mutual fund manager or own preference. And then we use this quasi natural experiment, right, to alleviate the concern. But I completely agree with you. You know, AI adoption is endogenous. We can't just attribute everything to AI adoption. There could be some other omitted factor that driving this both the adoption as well as the outcome. But hopefully the effort that we exert will alleviate the concern to a certain extent.
So out of curiosity, that before and after you matching turnover, do you see the results are very different? I think in general, I think you have done a lot for journals, kind of endogeneity concerns, right? But like I think for policy implications, I kind of want to know how does this AI channel relative to other channels, that both leading to short-termism, but like if the overall market we want to actually contain the short-termism, that what would be the relative kind of like mechanism or mechanism, right? Through AI versus other channels. So like I think one thing is I think you kind of like matching on the turnover on the previous slide, but like I think without matching on that, you have many other.
So this one is without matching. So table 3 is without matching. But because the sample are so different, so we can't really draw a definitive conclusion about whether it's kind of more or less pronounced. But I'll think more about it later. But if you look at just the magnitude, right? So this is without any matching, and this is matching. So after matching, this effect actually becomes stronger. But again, because the sample size is so different, I'm not like really confident that we can draw a strong conclusion just based on the magnitude of the results. Yeah, but that's a good question, right? So it's really like economically how big this AI adoption effect compared to other kind of forces, right, that could lead to short-term preference. Yeah. So we'll think more about that later. Yeah.
I think Ali He has a comment in the chat box. Yeah.
Yeah, I was commenting about one forthcoming RFS paper, which also has a measure for the AI adoption, but they use the Gen AI adoption. So perhaps you can take a look at that paper.
I know that paper. So it's a Shen Jinfei's paper, right?
Yeah.
The Shen et al. Paper.
Uh-huh.
Yeah, so the focus is actually quite different. To identify AI adoption is more challenging than I thought initially. I mean, they certainly have a very creative approach to identifying AI adoption. But first, they focused on Gen AI adoption, but our sample actually, I think, kind of largely predates the introduction or the popularity of Gen AI. So we really focus on like classic machine learning, those type of things. But I think their approach also quite indirect, right? So basically, they use their own AI to kind of making some kind of scores, right? Score the whatever conference call and then see whether the font treating are correlated with that, right? So it's quite indirect in my opinion, although it's also quite creative. But we can.
Yeah, it's creative
and it goes a different.
Yeah, there are more nuances when they use the ChatGPT to score the AI adoption, and we haven't arrived at the point to discuss more about human measures, but I actually have one question regarding whether you measure can conceptually capture AI adoption, because for me, adoption should be like time varying type of thing. But I think you just use the AI classification based on the manager's AI experience.
Yeah, so we basically at this in this version, so we just look at the first time they hire a manager, portfolio manager with AI experience. It could be either their AI related education background or their prior work experience involve AI, or their prior evidence of applying AI machine learning investment strategy, or they have some certification or publication of AI and machine learning. And we kind of assume once the fund kind of shift to AI, it'll stay AI forever. But that assumption can be relaxed. So we have tried we tested. Suppose they hire AI manager and later on this AI manager left the team and there's a new one does not have experience, then we classify they are non-adopted. So that result still holds. I don't know whether that's what you had in mind. So do you suggest that? Yeah.
No, I was just thinking whether the manager's AI expertise can fully capture the fund's AI adoption, because even though the manager, sorry, even though the managers have AI expertise, but it could be not fully aligned with the fund's investment
Yeah.
goals,
Yeah.
right? So.
Yeah. Now, there are certainly both type 1 type 2 error in our approach, right? As with any other kind of estimation approach with the Shins et al.'s paper, I think there's also type 1 type 2 error as well. That's certainly legitimate. Yeah, go ahead.
I was just thinking whether there is some measure that can capture the fund level AI adoption rather than them just using, because managers are still different from funds. That's my points.
Yeah. It's very good suggestion. Actually, I think that's a very important point. I really welcome if any audience here have a suggestion on like a better measure. I'll really grateful. So, but what I can share with you, like in the earlier version, we try other method as well. So we basically look at whether the fund manager company have AI patents. And we look at prospectors to see whether in the prospectus whether they states they're gonna adopt AI or machine learning kind of strategy. And there's something else as well. Oh, there's other things about experience. So we sort of combine all these three type of kind of a method together, and the result is still hold. But even with that, they may still not kind of fully address like the question you have in mind or the challenge you are thinking of, right? So how do we really accurately kind of classify AI adoption at fund level? Honestly speaking, I don't have a perfect solution for that, and I'm still working on a couple other projects on the effect of AI adoption. And if you have any good suggestion, I'll be really thankful and really happy to kind of try it. Yeah.
So I think Haifeng and Holly, in the chat box, I put a paper published in Journal of Finance. So I think their approach is very similar to you. They use LinkedIn profiles to identify whether a startup is an AI startup versus non-AI startup, right? Based on the LinkedIn profile, educational and experiences. So like you can probably cite that paper like you are using similar approach. And then the other way to get around this is instead of saying adoption, which you do not observe, you just can say those is the hedge funds have recruited, costly recruited AI background experts, right?
Right.
You can just change your construct technology or label to be more aligned with what you can observe, right? And this is such a costly investment to invest in AI related talent. So it's
right.
Whether they adapt or not, you cannot observe, but they did hire those people with a strong AI background. Yeah.
Right,
So
right. Yeah, those are good suggestions. I'll take a look at the paper as well. Yeah, and also think about what is the best kind of term to use to describe this. Yeah, that's certainly that will certainly be helpful. Yeah. Okay, Joshua.
Joshua.
So
Yeah,
again,
yeah. Feel free just to directly speak. No problem. Yeah.
so from my own experience working in a
Yeah.
money management firm, we
Yeah.
had, I think, about 10 people with PhDs, some of
Yeah.
them in very quantitative areas like
Right.
physics, mathematics, etc.
Yeah.
And instead of hiring somebody with an AI experience, we simply
Right.
send them to work on it.
Yeah.
The
I
fact
totally
that
agree.
you don't need to have somebody come from the outside to
Yeah.
signal the desire to move to AI.
Yeah. That's again, I think it's related to like what we discussed. We really don't have a perfect kind of measure how to kind of accurately, 100% accurately identify AI adoption. I fully agree with you. I chatted with Ayun even before the presentation. I work at the BGI from like 2007. At that time, we don't call our AI like a fund or anything, but we already use some of a machine learning, classic machine learning approach in our investment. That's certainly true, right? But I guess to really 100% accurately classify AI adoption is impossible. So one thing is that, as Ayun just mentioned, if we see this fund, they hire some AI, some portfolio manager with clear kind of AI experience or expertise. That will be a strong signal, right? That certainly seems to be that they may have incentive to or they're trying to use AI, but we can't exclude the possibilities that among other funds who doesn't hire AI portfolio manager, they didn't adopt, right? We can't draw that conclusion. So there's certainly type 1, type 2 error here, and I really kind of as I mentioned, I will welcome any suggestion on how to kind of improve the measure better. So in the past, we use AI with the company, the fund have any AI related patent, etc. So that could kind of capture what you mentioned. Maybe even if their portfolio manager do not have AI experience, but if their employee or researcher team, they have a lot of AI, pure AI, they may have some AI patent. But even for that, it's not perfect because a lot of investment companies don't really file patents, right? They just treat on the technology or treat on the secret they had rather than just put it file patent for that, right? So it's really challenging. It's really a challenging task to perfectly identify this. Yeah.
So one thing that you may be able to capture with that is there are some, I think there are some websites that collect what managers' presentations to public pension plans.
Yep.
And in those presentations, you may be able to capture if they say that they're using new data sets or new techniques. So that may give you a little more identified way of saying they actually making the steps to do that.
Right. Yeah, that's a good suggestion. So that may not be complete, but it will help to capture some of the adopters that we kind of missed here, right?
Yeah. So, for example, you mentioned the satellite imaging or conference call transcripts. If they say in presentations we are using it or we are investigating it, you could actually tag them as more AI driven.
We'll try that. We'll see if we can collect those presentations somewhere. So what we tried before is that we look at the prospectus, the fund prospectus, which describe the investment strategy. We find not so many of them explicitly say, we use AI and machine learning.
But presentations to prospects is actually where you're going to get the beef.
Okay. Thank you for the suggestion. We'll try to see if we can locate the data about the presentation. That's great suggestions. Yeah, thank you. Okay, so let me continue. If okay, so we have talked about the identifying AI fund. So here are some examples. So in this version, we kind of separate AI and machine learning from traditional quants. So if it is only talk about quants, we don't classify as AI. But I don't know, maybe that's a kind of overkill or not, but that's and so to measure short-termism, we just look at the association between their transactions, quarterly transactions with future earning change, and at different horizons, right? So we look at so basically we can look at from quarter 1 to 4 quarters ahead, and from 5 to 8, and 9 to 12, basically future 1 year, 2 year, 3 year. So if we see there's a kind of a change of focus towards short term, then we should see that beta 1 will be larger for short term future earning and will be smaller for longer term future earning, right? So before the analysis of look at the trade and future earning association, we also look at portfolio turnover. So here we match the fund. We have some AI adopters. We match them with the non-AI adopters with similar share turnover, portfolio turnover before adoption. And then we can see that after adoption, the AI fund, their share turnover increased substantially from about 0.6 to over 0.8. But for non-AI adopters, even if before AI adoption, their share turnover are similar, but after adoption, so after AI adoption, AI fund increases, but when they don't adopt AI, we don't see any significant change, right? So that's showing that AI adoption is associated with increase in the share turnover. And then we provide some descriptive analysis. Basically, we group the trade by deciles, basically the percentage of share traded, dollar amount traded by, I believe it's their AUM, and put them into 10 deciles. And we look at the AI fund and non-AI fund, look at when the trade and future earning change with the association. So as you can see, so for horizon 1 to 4 quarters ahead, actually the association between future earning change and their transactions are more positive than non-AI fund. But once you increase horizon to 5 to 8 quarters or 9 to 12 quarters, this reverse. So this is just some descriptive to see the pattern. And then we run this regression analysis to basically interact this trading with AI fund. And if AI fund, they have they focus more on short-term earning, we should see beta 1 become positive, and for short-term future earning change, and will become negative for long-term earning change. So that's what we find, right? So for 1 to 4 quarter ahead, it's really positive. So suggesting that for AI fund, their trade are more associated with short-term future earning than non-AI fund. But once you increase horizon to like 2 or 3 year ahead, this become negative and significant. So suggesting their less their transaction, their trade is less associated or less driven by the longer term future earning information. So this is the match sample analysis we talked about because we want to control for pre-existing or pre-adopting kind of font characteristics, right? We match on size, turnover, age and holding, etc. And again, the results still holds after we do the match. And here we do the dynamic effect. We look at like before the 3 year before the adoption, we don't see any difference or any change in in terms of the trade future earning association. It only happens after they're adopted. And then we even do a constant sample, constant holding sample, because one concern is that maybe after adoption, they have some preference. They're going to select some stock with certain characteristics rather than they collect more information about them. So we look at some constant holding sample. That this sample size is even smaller. But even if it's smaller sample, we still see these results hold as well. So and then we do a lot of the robustness check. We look at alternative measure AI fund, as we say. We look at their prospectors. We look at the patent, and then together with the manager's expertise. So the results is there, and we do a bunch of other things. I will not kind of elaborate too much here, given the time limit. So this is what I talked about earlier. So we look at we try to address the endogenous concern with instrumental variable approach. So basically, use two instrumental variables. One is the ex-ante exposure of the mutual fund to AI talent. So basically, we look at the AI strong universities. So they're do they have a lot of employee that come from AI strong universities well before this AI adoption period? So because if they have a lot of employee coming from those AI strong universities, then they facilitate the AI adoption. That even if it's unrelated to their own preference. The other one is geographic distance of the mutual fund from their nearest AI hub. So if it is closer to AI hub, maybe the information or technology spillover is make AI adoption easier as well. First we do we first do some pre-period placebo analysis to see that before this AI adoption period, which is from 2000 to 2009, whether the AI talent exposure distance to AI is associated with this information horizon of their treat, and we find those instrumental variable are not related, does not affect the information horizon. So this kind of placebo analysis to showing that this before the AI adoption, this does not have effects. And then we use a kind of 3-stage or probably 2-stage least square or we call 3-stage probably 2-stage least square procedure to do this instrumental variable approach. I will not elaborate why we're doing this, but trust me, there's some reason and some studies showing that we have to do this. So basically, here we're showing that the AI. So this is stage 1 and 2. We show both AI talent exposure and distance to AI hub. There's significant associated with probability of AI adoption. So if you have more AI talent exposure, then you have high probability of adoption. If you have longer distance, it's reduced your probability of AI adoption. So again, this hopefully they are relatively exogenous to companies' own preference or choices, but it's certainly not 100% exogenous, right? And then at the third stage or the second stage, we replace this AI fund with kind of native value, and this result still hold whether we use AI talent exposure by itself or distance to AI hub or both together. So we're showing actually those coefficients even become larger, showing that if you address endogeneity using variable, this effect become even more pronounced to a certain extent, right? And then we look at the quasi-natural experiments, two plausible exogenous shock that increase AI effectiveness. One is a transformer, the release of transformer architecture, the paper published in 2017. The other one is staggered introduction of satellite image data. So both showed the increased AI effectiveness. And if AI adoption or AI technology increase the short-term acquisition, if it increase the marginal benefit of short-term acquisition, we should see that after those exogenous shock, that short-term mismatch should become more pronounced. So this is for the transformer. So we can see that after the transformer release, this short-term association of the association between treating and future short-term earning, they become more pronounced positive, and long-term become more negative. So for the staggered introduction of satellite image, we see that for quarter 1 to 4 quarters ahead, this positive, this increase, and from the second kind of horizon, basically second year ahead, they already turn to negative. But for the third year, it's negative but insignificant. So kind of partially consistent with our prediction. So that's kind of the approach we try to deal with the endogenous concern. And for the AI investor ownership and future stock pricing effectiveness, I'll just quickly go through results. So it should be quite straightforward. So basically, we try to look at whether high AI ownership kind of lead to increase in stock price, short-term stock pricing effectiveness, and decrease the long-term stock pricing effectiveness. So we use both the Bat et al.'s paper approach. So basically, how much current stock price information reflect future earning, right? So we can see that for companies high AI ownership, then for the short-term future earning, so the stock price or this is the market value of equity. So it reflects more of the short-term future earning, but less of the long-term future earning. So we use both share-based measure and count-based measure. So they're both consistent our results. And then we also use this kind of instrumental variable approach. So I will not go to too much details, but using instrumental variable approach, we can see the results actually still there and somewhat stronger, if anything. And we also use a future ERC, which is developed in the accounting literature. So basically run a reverse regression of stock return on future earnings and interact with AI ownership. Again, we can see, so in the same regression, dependent variable stock return, so independent variable future earning of different horizons, interaction with AI ownership, we can see that for the short-term future earning, so the coefficient is positive, suggesting that for stock with high AI ownership, so the stock price is more reflective of short-term future earning. But for the longer future earning, so this becomes negative. So again, consistent with our kind of short-termism prediction. Okay, so we also did this constant shareholder analysis. I'll not bother you with these details. And then the investment Q sensitivity basically follow the same kind of process. And again, it was to show that this AI ownership interaction with Q and the investment sensitivity all become lower for companies with high AI ownership. So whether it's in OS regression or second stage IV approach, they're both showing this consistent results. And for the constant shareholder sample, that we again see these results. So basically, I think that's pretty much all the main results I want to introduce. I want to share. So any questions, I'm happy to answer.
Thank you, Haifeng.
Oh, yeah. Yeah, by the way, this is next scheduled event. So this is the task that you asked me to do. I'll show it throughout this on the slides here.
Thank you. I'm going to stop recording and see if anyone has questions.